Hola, buenos días. Les habla Carles Gaju, gerente de distribución institucional. Y en nombre de BICE Inversiones les doy la bienvenida a nuestro webinar Stepstone Secondaries Fund 5. Hoy nos acompañan Tom Bradley y Mark Maruszewski, ambos partners y co-heads de la estrategia de secundarios de Stepstone, y Shannon Bolton, Managing Director de Stepstone. El objetivo del webinar será presentarles la estrategia de inversión de Stepstone, su track record y sus proyecciones en el marco de oportunidades del mercado secundario. Al final de la exposición tendremos tiempo para conversar con Mark y Tom, por lo que pueden ir escribiendo sus preguntas en el chat y después las agruparemos para responderlas al final de la presentación. Como siempre, Shannon, te doy también la bienvenida. Muchas gracias por estar hoy con nosotros. No sé si quieres también hacer una breve introducción al equipo o partimos inmediatamente con Tom.
Hola, Carles. Hola, estimados. Muchísimas gracias por el tiempo. Thank you for joining us this morning to discuss our Stepstone secondaries strategy, our fifth fund that we are currently starting to fundraise for. I just want to quickly say thank you again for your time, as well as to BICE. Thank you for helping us organize this chat with you today. So joining us are our two co-heads of the secondaries practice, Mark Maruszewski and Tom Bradley. They have been partners working specifically in the secondary market for over 20 years. I think that's very important when it comes to understanding how the secondary market works, and also their viewpoint and having been able to see the evolution of the secondary market. I want to stress that our strategy is different than perhaps some of the secondary strategies that are in your portfolio. We do see this as a complementary strategy to these large mega secondary funds. And you will, Mark and Tom will go into detail about why our strategy is different and why it is complementary. So with that said, I'll turn it over to Tom, who will walk us through a bit more detail about who is Stepstone and our strategy. Thank you again for your time.
Great, thank you, Shannon. Thank you, everybody, for joining. We are very pleased and appreciative of being able to spend time with you to tell you more about Stepstone and our secondaries practice. A lot of the points to which Shannon have made relating to our differentiation versus other secondary funds and other private equity platforms in general. You know, Shannon mentioned that Mark and I have been partners together for over 20 years, and I think that that's important because the genesis of the strategy that we employ at Stepstone is informed by that history. The secondary market today is in fact quite crowded, and you have lots of different options to choose from. In fact, we would argue that it's been crowded for quite some time, and about 10 plus years ago, when we both came to Stepstone, we came with a vision of creating something different within the secondary space that others weren't offering. We think we've found that and been able to create that at Stepstone. We hope that this presentation will give you some insight and belief that we have done that and achieved that. And as much as we'd like to think our history in the business of having participated in secondaries for over 20 years is the secret to our success, I think Mark and I would both present to you that the real secret of the success of secondaries at Stepstone is a marriage of an incredibly powerful platform that gives us advantages that allow us to do things that others don't, along with a strategy that targets specific top tier, top quality private equity. And we'll show you how we do that. If Emilio, if you could push on to the next slide, that would be helpful. When we, one more slide perhaps. Whenever we have these presentations, for those of you who may be familiar with our platform, we always like to reiterate where our platform is today because, again, of how much advantage it gives us in the secondaries practice. Stepstone today is a very, very large organization. If you look at the top of the slide there, we oversee $420 billion in private markets allocations, $86 billion of which is assets under management. And most importantly, particularly for the secondaries practice, That third number from the left there on the top of the page is most important. We're committing about $50 billion into private markets through annual commitments every year. And that makes us one of the largest investors in the world globally in private markets. And that's really important because it makes us an incredibly important customer or relationship with general partners, who therefore will provide us with opportunities that they don't to others. They will provide us with information that they don't to others. And all of that creates better deal flow and allows us to make more informed decisions about what we buy. Of course, we are a private markets platform in addition to private equity, which is what we're talking to you about today. Stepstone also is a scale investor in private equity real estate, infrastructure and real assets, and private debt. And we operate each of those segments of the private market in the same way and form in which we operate our private equity business, in that we have both discretionary asset management and advisory practices. And that's very important because the latter allows us to have more information, more relationship networks with all of the general partners that invest in those asset classes. And it just makes us a more informed, broader investor. Emilio, if you could flip again to the next slide, slide 6. This further bears down on our private equity practice in particular. Stepstone is a global organization with 19 offices in 13 countries around the world. And in each of those established private equity markets, we have investment professionals who do analysis on GPs within those areas and have relationships with those general partners. And that's very important because we believe that you have to have feet on the ground in established private markets areas so that we know those managers and will have a better sense of the value of the assets that we're looking to buy in any particular secondary transaction or primary investment or co-investment. But you can see the breakdown there on the bottom page. The GP relationships that we have and the investments we have are very deep and wide across the globe. We can switch to slide 7, just further sort of talking about our private equity business and the way in which we operate. We invest in private equity through 3 modes. We invest on a primary basis, making primary commitments to private equity funds. We are a co-investor investing alongside general partner sponsors with whom Stepstone has relationships with. And of course, as we are here in the webinar talking to you about, we are a very significant secondaries buyer. Again, I just want to reference the importance of our primary commitments. You'll see at the top there through our global primary platform, we're making $45 billion in annual private equity primary commitments. The number that I had provided 2 slides prior was $50 billion. That's across the market, private markets platform. The lion's share of our business is private equity, as you can see, and we are one of the largest investors in the world, investing globally on behalf of some of the largest and most sophisticated, long-standing private equity institutions, which of course makes us very attractive in the eyes of general partners with whom we are investing. We sit on over 250 advisory boards through those primary commitments, which makes us a very informed and influential investor, which of course all helps our secondaries business. We're taking over 4,000 GP meetings per year. GPs are coming to Stepstone, providing us updates on their portfolios on a regular basis because of how much we have committed to their funds, or in certain cases where we have not made commitments, they are trying to establish relationships with us because of how much we invest annually and how generally important we are in private equity. All of this is tracked by the largest private markets database in the private equity business, which we call Stepstone Private Investments, SPY. And I would urge you all, to the extent that you haven't seen our database, to have Shannon provide a demonstration, because it provides a unique advantage to us, particularly on the secondary side, in having information that others don't have. So the primary business is really the engine that helps our co-investment business and our secondaries business. We have a significant co-investment business with 12.5 billion committed over almost 200 transactions since inception. That business operates in much the same way our secondaries business does, in that because of what a large primary investor we are, we often get favoritism in terms of deal opportunities and insight that GPs provide us for co-investment opportunities. That happens as well in secondaries, where because of what a scale investor we are, we often get opportunities, particularly among best-in-class GPs in negotiated or less competitive transactions that will tend to outperform other secondary transactions that others see in the marketplace. Emilio, if you could flip to slide 8. You know, we have a very experienced team with almost 20 years of average experience, almost a decade of tenure. I mentioned how many advisory boards we sit on, but importantly, the way in which we are structured at Stepstone. We draw upon the specialization of the multitude of investment professionals we have across the globe who really are specialists within particular areas of private equity. And so you'll see Mark and I co-manage the practice together, overseeing that practice with Adam Johnston and John Ketnick, drawing upon investment professionals from around the world who sit on various sector teams, of which we have over 10. You'll see above each individual, it highlights a particular area of the private equity market that we utilize for specialized expertise whenever we're looking at a secondary. So for example, even though Mark and I have been investing in private equity for over 20 years and therefore may know certain growth equity managers to be of very high quality, we don't have the particular area of expertise to really understand, other than reputation, how good that particular growth equity manager may be. So if somebody comes to us and says, I have a $50 million interest in an Insight Venture Partners Fund 4 that I'm interested in potentially selling at a single-digit discount, is that something you can do? Mark and I, although we know Insight to be a very high quality in name brand, we will leverage the expertise and granular knowledge of our growth equity and venture capital sector team in John Coelho and Brian Borton, who are on the top row and the second row there. And what we'll often play back is they will come back and they will say, we know Insight Venture Partners on a primary basis. Stepstone has actually committed $300 million to both of their last 2 funds. We sit on both of their advisory board. And we know that because of that, that Insight Venture Partners 4 happens to be held at a 1.2x multiple of cost, and has 3 companies that are going to be written up, and therefore there's going to be uplift in that portfolio within the next 2 quarters to a 1.5x. And so yes, you can buy that at a 5% discount, because your real discount is actually going to be closer to 17%. Having that granular knowledge is really helpful and provides massive advantages to us as a secondaries platform that we can only have because of the broader Stepstone platform and how much we invest on an annual basis and the specificity of the way in which we invest. The secondaries team is supported by over 200 investment professionals globally. And then, of course, if you flip to slide 9, Emilio, it's further supported by a world-class, very experienced, deep bench of expertise across legal, investor relations, and finance and accounting. So that's the platform from which we operate. If we can flip to slide 11, I want to talk to you with a little bit more specificity about our secondaries practice. You know, Mark and I joined Stepstone in 2010, basically with the idea, as I mentioned before, that the secondary market was quite crowded. Most secondary buyers were fighting to buy portfolios of assets with no differentiation other than paying the highest price. And so we thought, is there a way in which we can create differentiation within secondaries to provide a more attractive risk-adjusted return for investors? And part of the thesis was, bolting ourselves to a platform that would allow us certain advantages, many of which I've talked about. So Stepstone, as I've said, is a very large platform that's making significant primary and co-investments on a yearly basis. That provides us with significant sourcing and diligence advantages, as well as information advantages that we have in the form of our database that we use to track the primary and co-investment commitments that we're making for our discretionary asset management and advisory clients. If you take the platform advantages that we just discussed and marry that with a strategy that actually doesn't focus on buying portfolios, that actually only tries to focus on buying the best private equity that comes for sale in the secondaries market, we thought that was a recipe for differentiation. So our strategy focuses on buying basically single interest or single manager transactions, because we can isolate sort of best in class. We're only interested in buying the best secondaries that come to market, not the portfolio. So for example, 84% of everything we purchased in our most recent fund are first and second quartile managers. And if you're an investor in private equity, you should know that there's a huge bifurcation of returns between the best and everybody else. Best in class managers tend to continue to outperform, and our thesis, certainly on a primary basis, is that you ought to invest in best in class managers. But if you can do that on a secondaries basis, that also provides you with a pretty compelling investment proposition, which should outperform. So we're focused on not buying the index, but buying best in class managers. And also not only best in class managers in name, but also making sure that those underlying portfolios in the best in class managers that we're buying into are healthy, growing, and provide for value accretion. And we've done that too. We're also buying those at above market discounts, which is really the holy grail. If you can buy best in class managers at above market discounts, that clearly ought to be a recipe for outperformance. And throughout the history of our practice, we've achieved a 20% discount, average of a 20% discount in our LP purchases. And that's something we don't see other secondary fund groups being able to offer, again, because they're usually not buying single interest transaction off of such a powerful platform that gives them leverage. We're also, again, buying, because we're not buying portfolios, our funds tend to be a little bit more concentrated than the mega secondary funds. You know, if you're invested in, say, a Lexington fund, you're going to be, or an Ardian fund, you're going to be invested in thousands of underlying partnerships, which is good, I guess, if you want exposure to private equity, but you're really getting exposure to the index of private equity and paying private equity fees. Our portfolios are going to be more concentrated with about 80 underlying fund interests, the majority of which, remember, will be first and second quartile managers. So very high quality portfolio, and you get enough diversification such that you're protected, but not too much diversification such that you're a prisoner of inertia to the index. The great majority of the deals that we do are with, again, one or two managers, because we're trying to isolate quality. And we tend to focus on the small and middle market area of private equity, because that tends to outperform other areas of the market. And we'll provide some data later in the presentation that shows you what we've bought. Additionally, we focus very much on risk mitigation. And while other secondary funds have really begun to employ more financial engineering because they're trying to enhance returns to that which will be acceptable to their underlying investors, or because they're fighting in competition and need to stretch in price, we have the benefit of not having to use leverage because of the processes in which we are generally fishing in, which tend to be either negotiated or less competitive because GPs are pushing opportunities our way. So all of that has created through time over $5.5 billion that we put to work in our secondaries program, producing net interim rates of return on an unlevered basis thus far of 19% and a 1.7x cash on cash multiple. let's push on to the next slide, if you would, Emilio. Secondaries market has changed over time in that 15 years ago, a secondaries used to be wholly defined as an LP interest in a fund that was being sold from one LP to another. And GPs used to not want to participate in the market other than know that the replacement limited partner coming into the shoes of that selling limited partner was creditworthy and would continue to make capital calls. Well, the market's changed because GPs have realized that the secondary market can be quite strategic to them. And that means that GPs are now more involved in directing or influence, or in fact, creating secondary opportunities so that they can strategically enhance their business. That's terrific for Stepstone because we tend to get the first call when GPs are involved because GPs want to partner with Stepstone. And you can see we continue to do a plethora of traditional LP transactions in the form of 100 deals closed, about $3.5 billion in commitments. And we are also doing GP-led or directed transactions increasingly, which we like, and we think we have established a very good track record of doing thus far with 37 deals closed, over $2 billion of commitments made, with, again, a very attractive interim track record. And in each of those cases, we are partnering with or buying into very high quality managers, as I just mentioned. So the GP transactions, which 5 years ago used to be sort of mediocre to fallen GPs, have now completely reversed and tend to be very high quality GPs who've recognized the importance of secondaries and how that can be strategic and helpful to them. So there's some of those names there on the bottom on the right hand portion of the slide. Moving on to the kinds of deals that we look for and what we look for in attributes that we think differentiate us from others. Emilio, if you could flip to slide 13. We try and look for a preponderance of deal dynamics, one slide back on 13, if you would, that really define transactions as signature Stepstone transactions. And while you're not going to have 100% of the deal dynamics we want to see, we generally have a preponderance of the deal dynamics that you see there in the boxes at top. So we generally want to have some assistance from general partners with whom we have relationships with and we think highly of. We generally want to see that those GPs are what we would rank as first and second quartile managers. We want to believe that we have an information advantage in looking at any secondary opportunity over anybody else that might be looking at that particular transaction, including more often than not, by the way, the sellers themselves. And we believe that we have that because of our relationships with GPs and because of our SPY database. And we want to believe that we're getting an above market discount buying those transactions in less competitive basis. And you can see in both the LP partnership interest transactions that we purchased there on the left-hand portion of the slide and the GP-led transactions, well, we're not going to have, again, all of the metrics of deal dynamics that we'd like to see. In almost all cases, we have a preponderance, if not all of them, and they are with very high quality managers, some of which I'm sure you all know, others of which perhaps even if you don't, Stepstone has ranked them as first and second quartile managers that we have recommended we commit primary dollars to on behalf of our advisory clients. I'm going to hand it over to Mark, who's going to talk to you more about what we purchased in those secondary transactions, the quality of those transactions, as well as take you through sort of our track record and the makeup of our portfolio.
Thank you, Tom. And thank you everyone for being on the line with us today, both current and prospective investors. As Tom mentioned, next slide, please. As Tom mentioned, the challenge of most secondary players is that they don't have enough information, or they don't have information on all funds. They also have the challenge of deal flow, right? Most of them get the majority of their deal flow from the auction market. And they're also challenged by knowledge and relationships. And so if you're seeing a European distress fund or an Asia growth equity fund without people on the ground, without relationships with those managers, it's very hard to assess what the real risk return is of a particular opportunity. So, and Tom and I lived this life, 10 years prior to joining Stepstone. We were at another secondary platform that had those challenges of information, deal flow, and knowledge and relationships. And what typically happens, particularly with very large funds, those funds tend to get the preponderance of their deal flow from the auction market. They're protected in so much as they're buying very large portfolios, and so they may not know everything about a portfolio, but they buy at a particular price, and they're protected by the yin and the yang of the return profile of a over diversified fund, and that typically leads to beta portfolio construction, as Tom said. And so, 11 years ago, we sought out to develop Stepstone secondary platform, believing that the information advantages that Tom talked about and the primary capital would lead to proprietary deal flow. And armed with people all over the world, we'd be able to understand at a more granular level what was available and to purchase, and what the higher quality assets were to purchase, within the global pipeline of secondary opportunities. And so this chart, or this page, kind of represents what we've achieved in our last fund. As you can see on the left-hand side there, it's very different than the profile of other secondary funds in the marketplace. And so we would submit to you that it's very complementary to some of the secondary exposures that you already have. Almost 85% of everything that we've purchased in our last fund is either a first or second quartile fund. Characteristically, in first and second quartile funds, it has very, very strong revenue growth rate. You can see that the growth rate across the top 25 companies is approximately 8%, and very high EBITDA growth rates. You can see 34% growth rate across those same 25 companies in the portfolio. Extremely low leverage and a 0% loss ratio. And on the right-hand side there, you can see some of the names of the partners, the managers that we've partnered with over our most recent fund. So it's very different. It's kind of a natural alpha generation that you get from our portfolios. Most other secondary funds rely on over diversification and then, paying a high price, but then putting leverage on those portfolios to achieve a higher rate of return, which, as everyone knows on the phone, that leverage does carry with it additional units of risk and can either amplify or destroy returns depending on the direction of the overall market. Next slide, please. In terms of portfolio construction, again, to this point of natural alpha in our portfolios that allows us to stay away from leverage, approximately 87% of all the deals that we've done are with 2 sponsors or less. It's one or two sponsors that we're buying at a time. Again, to Tom's earlier point, we're buying what we know that across the platform has been analyzed with managers that we have very, very deep relationships with. So the team globally knows just about every manager in the marketplace, knows their portfolios, knows their internal systems and structures in terms of economic sharing and whatnot. And so we can very confidently lean in on high quality sponsors. And as Tom suggested, those sponsors, because of how much primary capital we're putting into the marketplace and because of how many clients we represent globally, we're number 1 or number 2 globally in terms of capital allocations. Those managers are providing kind of supreme cooperation, which means giving us unbridled access to information, limiting competition, or both. The second data point there is representative of what we're buying. Approximately 2/3 of our portfolio is focused on small and middle market buyout and growth equity. That's very important because those 2 segments of the private equity marketplace tend to have higher natural growth and more kind of value arbitrage, if you will, as these small and mid-market companies tend to grow and begin to attract larger multiples ultimately when they are liquidated. The average age of the assets that we purchased is approximately 4.5 years. Again, we're not buyers of tail end portfolios where we're just realizing our discount on that tail end portfolio. We're actually buying companies that are young and still in their growth phase within the portfolios of the managers that oversee those portfolios. And as Tom suggested earlier, we're not buying thousands of funds on your behalf. We're diversifying our portfolio across plus or minus 70 fund interests so that you have diversified alpha, if you will, as opposed to over diversified beta by investing in one of the mega funds. So I think our portfolio construction and some of the metrics of our last fund kind of represent how we very much are complementary to other secondary and differentiated from other secondary managers in the marketplace. Next slide, please. Again, information, when people think about information and the information advantage, it's extremely, extremely important. As I mentioned to you earlier, Tom and I spent 10 years at a competitor platform where we were starved for information, but information just doesn't mean data on underlying funds. Information is really reflective of a global footprint. Do you have offices in the local marketplaces where there are active private markets activities? Second is, do you have a team of individuals that have relationships with these managers that have been tracking them for years, that understand the granular specifics within their portfolios and the growth potential, particularly against a backdrop of a local capital markets that may provide liquidity? The third, of course, which is the traditional view of information, is database. Some of you have demoed our database in the past, but the market reaction to our database, which we do sell to clients, is that it's broader and deeper than any database in the marketplace. It's very, very important when you are pushed an opportunity to buy 50 funds. If you have the people, the global footprint, and the data to ascertain the highest quality opportunities within that 50 fund portfolio, it allows you to be kind of a rifle shot hunter and pick out the very highest quality, highest growth assets from within that entire portfolio. And that just positions us to outperform naturally relative to our competitors. And then finally, we have a very sophisticated data science and engineering team of 35 individuals that have built proprietary models that allow us to complement our kind of bottoms up and top down fundamental analysis with proprietary statistical models that also predict how a particular portfolio or how a particular fund will perform, almost as like a check and as a means by which to be more efficient in our modeling. Next slide, please. Again, we've talked a lot about how relationships matter, and this graphic, although complicated, illustrates how important relationships and capital is to the general partners that we invest with. So this is a graphic that shows our relationship with PSG, or Providence Strategic Growth, one of the probably the number one or number two growth equity manager in the technology space. In the light blue, you can see our cumulative commitments to that manager through 2021, which totals approximately $3.4 billion in primary, secondary, and co-investment capital. Now, if you're one of the largest clients of an institution like Providence Strategic Growth, they're naturally going to push you secondary and co-investment opportunities to try to build on that relationships. We frankly have more capital. We are their largest capital provider, and we have more clients across more geographies and of more varied size than anyone else in the marketplace. Again, totaling $3.4 billion. But the blue dots there, you can see co-investment opportunities that they've shown us over time. And the yellow dots you can see are secondary opportunities that they've shown us over time, some of which we've pursued, some of which we've passed on. But again, it's this, natural symbiotic relationship of general partners taking care of their best customers. Just like any industry, institutions or corporations tend to take care of their best customers, and we tend to be a best customer to the largest and most successful private equity managers in the marketplace. And because of that, they're willing to provide not just information and unbridled access to their team, but they're also willing to push us opportunities and restrict competition, which again is an important ingredient to our success. Next slide, please. As Tom mentioned, we care very deeply about the quartile rankings of the managers that we invest with. And as you can see on the bottom right there, 75% of all the managers that we purchase interest in are either a first or second quartile performer. And we've bought that exposure at a weighted average discount of 20% over time. So if the holy grail of private equity is to concentrate your portfolio and to outperform is to concentrate your portfolio in largely first and second quartile managers, if you can also achieve that by getting that exposure at a 20% discount, that's a very, very powerful combination. The blue line here on the graphic shows where the auction market is selling portfolios to all the other buyers in the marketplace. So typically, other buyers are buying first, second, third, and fourth quartile funds at an average of 85 to 95 cents on the dollar. But in yellow there, you can see that we are buying largely first and second quartile funds at an average of 80 cents on the dollar. So again, larger discounts on higher quality product relative to what others are doing in the marketplace. Next slide. As Tom mentioned, what we do is we buy a mix of LP interest, typically one or two funds, and GP-led opportunities where a manager is selling a handful or even a single asset that they want to retain. Those tend to be their highest performing underlying companies that they want to retain because they have improved the operations of the business, believe that the growth of the asset is still quite strong, and they have incorporated or instilled a very high quality management team to manage those assets. So typically managers, best in class managers today don't want to sell their best companies to their closest competition or the public markets because they lose out on an opportunity to make another 2 or 3x return on that particular asset. So on the left-hand side, again, LP interest, we bought an interest. These are just some select recent transactions. We bought an interest in Cinven, which is one of the most successful pan-European buyout managers. Our European team knows it quite well. We closed that transaction at a substantial discount, and it's marked at a 1.6x ROI already. So again, this is the importance of understanding who the managers are and what the quality of their underlying portfolio is and what the growth profile of that underlying portfolio is. Again, on the bottom left, you can see Project Balfour. As Tom mentioned, we don't like buying multi-fund portfolios, but in this particular case, 23 fund interests of very high quality, small, middle market, and large buyout funds, where we were kind of the only buyer that knew all of those fund interests and really understood at a granular level what the growth potential was for those underlying assets. We closed that portfolio at a 30% discount.
Mark, I just want to mention in this particular case, as Mark points out, we don't generally buy portfolios, but there were 7 GPs within this portfolio that really wanted their fund interests to go to Stepstone. So you have a portfolio that's sort of being held hostage by several GPs, such that Stepstone is really the only natural buyer. And as Mark points out, we don't generally like to buy beta, but if we can buy beta and if we can buy the index and create an alpha-like return, we're happy to do that. Normally portfolios don't sell at such large discounts, but in this case, in Project Balfour, as you can see, we got about a 30% discount because, as Mark said, we knew much about the underlying portfolio. Most importantly, that there was significant uplift in the near term, which got us comfortable with being able to buy that particular portfolio.
And on the right-hand side, there are two examples of GP-led transactions. These are situations where both Ampersand and PSG wanted to take three of their best performing underlying assets and direct those opportunities outside of an auction process to Stepstone, given that we are either their largest capital provider and client provider and or their highest growth partner in private markets. So, you know, both of those managers are extremely high quality managers, one in the healthcare space, one in the technology space, and in previous iterations have done 2 to 3x on doing secondary transactions with each of those managers. Next slide, please. Talk a little bit about track record. As you can see, you know, our program started in 2009. We've effectively increased the size of our program by about $1 billion in each successive fund that we've managed. But if you look in the middle there, again, unlevered, very attractive net cash multiples of 1.6 to 2.1x, and extremely consistent IRRs in the high teens. Fund 4 is showing a much higher IRR, just reflective of the discount, early discounts on those portfolios. Maximum cash at work typically are in the 40 to 55% range, meaning if you make a $1 million commitment, you're likely only going to put up 45 to 55% of that commitment ultimately, because of the cash generative nature of secondaries. Blended returns are 19 and 1.7x net cash multiple. We're very pleased with the track record, and again, without the use of leverage, we think it's quite complementary to what else is available in the marketplace. Next slide. This is an update for those of you that are in Fund 4. As you know, we activated Fund 4 in June of 19, so it's, you know, approximately 2 years old. The net cash multiple stands at 1.6x and 85% gross IRR. The net IRR is higher than that, just reflective of the early discount and the fact that we've used our capital call facility to fund these investments before we call capital from you, our investors. It's a mix on the bottom left there. You can see it's a mix of LP interest purchases and GP-led recapitalizations. There's about a third of the fund that still remains uncommitted, which we will complete the deployment of in the next 3 to 4 months. But this portfolio is performing, you know, well ahead of plan. We have approximately 100 funds within the portfolio, and almost 90% of the funds that we've purchased is either one or two managers in the portfolio. Again, 84% first and second quartile sponsors, so very, very high quality. We typically focus our portfolios on North America and Europe, representing around 60 to 70%, and the rest being Asia and rest of world. Next slide, please. As many of you probably know, a good quarter in private markets, particularly when you're talking about a diversified portfolio, is, I don't know, 2 to 2.5% per quarter gain. But as you can see in the green bars there, we've had, 8% to 40% gains quarter over quarter in our portfolio. Again, this is reflective of the very, very high quality underlying assets and the quality of the managers that are overseeing these portfolios. We did have one down quarter in the first quarter of 2020, which is just reflective of, the onset of COVID, but the portfolio bounced back very quickly from that. But at no point in time did we have a negative J curve. You can see in the blue line there, the the rolling net multiple of the portfolio, which stands at about 1.6x TVM today. Next slide. And again, just to give you some insights into the portfolio, again, this portfolio is less than 2 years old. Some of these transactions are less than a year old. In yellow, the yellow dash marks there just represent where we underwrote our base case underwriting for each one of these transactions. These are our largest 10 transactions. And you can see some of these transactions have already met or exceeded their terminal underwriting. So we typically will hold a portfolio that we purchase for 5 to 7 years. But here we are in year 2, and some of these have already met or exceeded their base case underwriting. So extremely strong early performance, nothing below plan to date. And we have very high confidence that this portfolio will be one of our strongest that we've ever assembled. Again, which I think is reflective of all the themes that we have talked to you about today, right? We have confidence in this portfolio being one of our strongest performance because it's so concentrated in the first and second quartile managers, and because the revenue and EBITDA growth rate of the underlying assets is so strong. Next slide.
That's pretty much the slide presentation, Mark. I think we have the more color on some of the largest transactions. I don't know if you want to highlight any of those, but
I don't think so. I mean, the audience can look at this themselves, but this just shows these 2 slides show our largest transactions, and it effectively shows that the 3 largest transactions on page 25 here are at 1.7 to 2.5x, and if you forward to the next slide, the next 3 largest transactions stand at
2 forward.
Yeah, the next 3 transactions sit at 1x to 1.6x. So again, just a window into the performance of the underlying portfolio. And then on the subsequent slides, we just show the performance of Fund 3, which again is very similar to that of Fund 4. Very high quality, very much concentrated into first and second quartile managers, and very, very high growth rate across the portfolio on a quarterly basis.
The only other thing maybe to just highlight, and Shannon can forward it on for investors to look at their leisure, but Emilio, beginning on slide 45, we do show every single secondary transaction that we've done at Stepstone. And this will just help you understand that, as we have suggested throughout the presentation, we're really looking for, we're taking a rifle shot approach, trying to find best-in-class secondary private equity as opposed to buying portfolios. So again, it highlights in the second column to the left, you'll see in the number of funds, we're generally buying a single fund here and there because that's of extreme quality. 2 funds could be the same manager, but as Mark alluded to in some of the examples, we're happy to buy portfolios, but we want to make sure that the portfolios are of high quality and have significant value appreciation that we can buy at large discounts. So we're happy to do that on occasion, but they are rare, as you can see from that. And so the successor slides will just go through sort of every single transaction we've ever done and the current performance of that transaction. But I just wanted to highlight that.
And so, maybe just to summarize, Tom, before we hand the presentation back over and field any questions, I would just say again to this point of differentiation, the portfolio construction that we pursue is quite differentiated from anyone else in the secondary marketplace, focused very much on quality. Further to our differentiation from other market participants, we have more information through people, offices, and data We have more proprietary deal flow because of the client profile and the amount of capital that we're putting to work. And we have, I would say, more knowledge and relationships to get intelligent on the portfolios that are, and to get updated on the portfolios that are available in the marketplace than anyone else in our space. And I would just say that, it's the same senior team, that's been together since Fund 1. The strategy has remained consistent. We believe that because of the growth in GP-directed deal flow, there's nobody else in the marketplace that's better positioned because of our capital and our client base to be a beneficiary of this deal flow than Stepstone. And I think we believe that that's a recipe for continued natural, unlevered outperformance relative to our competitors. So with that, I'll turn the presentation back over to BICE and Shannon.
Thank you, Mark. Thank you, Tom, as well, for introducing your strategy. We have a couple of questions from the audience. So the first one is related the relation between, as you mentioned before, the important to have this relation with LPs. So the question is, how does your relation with the seller LPs who later learns of the uplift of the fund? You buy this share from LPs that at some point realize that the fund itself got an uplift. So what are the relation with these LPs that sell a good asset or good units from one of the fund? If you can elaborate on that, please.
So I'm not quite sure I understand the question. If the question is why do LPs? What's our relationship with LPs who are selling good assets? Is that why would any?
Yeah. I think I will rephrase the question. You are looking at some deals where you will buy some stakes from some LPs that maybe have some relation with you, and you buy this stake with a discount maybe. Yeah. And then they see the uplift. So at some point, with some LPs see that you are interested with that transaction, maybe. I know that's, if you can elaborate on how you deal with this relation. No one wants to sell a good asset at a discount. So that's maybe the question.
I guess I would say we're generally buying. Most of our deal, the preponderance of our deal flow comes directly from general partners who suggest to us that they have an LP in their fund that's interested in selling, and it's our desire to have this interest go to Stepstone as opposed to a regular way secondary buyer. And so we're generally brought in by a GP who is trying to create a good strategic fit for them. We don't buy LP interests from our advisory clients. So we generally don't have a relationship, at least in the negotiation, with that particular LP from which we're buying that partnership interest from. And when an LP sells an interest in their fund, generally that's the end of their relationship with that GP. And they may know sort of anecdotally that there's value left in the fund and therefore they've left money on the table, so to speak. But generally they're selling for reasons related to their own institutions. They need liquidity, so they've already made a strategic decision to sell that particular interest. And so they're not really worried about the value that they're giving up as much as trying to achieve the objective that they need to achieve in selling that particular interest. Does that answer the question?
Sure.
Tom, I would just add to your commentary and just share that oftentimes, sellers are selling at a gain, and so. Sure. Oftentimes they're very happy. They've done well on this investment, and the investment is going to continue to grow in our view. And so they're fine getting out at a 1.5 or 1.75 or a 2x multiple, and we're fine being in that investment and making 2x ourselves. So, but it's also, as Tom suggested, human nature. People generally don't want to go back and see if they made a good trade or not. They want to kind of deny. Ignorance is bliss, right? And sure. So generally people don't go back and say, did I make a good trade or did I make a bad trade? They take their proceeds, they readjust their portfolio or their private markets relationships, and they move on.
And I think
Thank you.
also, just so it's clear, if it wasn't the president, we generally know more about the underlying portfolios and the projection of what the value of the underlying portfolios will be than the sellers themselves. So once they sell, to Mark's point, there's no sort of stock tracker that tells you what your interest in Insight Venture Partners 4 would be 4 quarters from now. Once they sell, they're not going to get any more information. So, out of sight, out of mind.
Got it. Thank you, Tom and Mark. A quick question regarding what we are discussing about, good deals, having good assets with a discount. So, I mean, that's maybe the secret of the strategy. How do you get good deals with a big discount or bigger discount than the other parties? So try to give us, is another question from the audience. So if you can, combine, how do you get those deals that are better in terms of the asset and with a big discount rather than the competitors?
Yeah, there's typically two means by which we get or achieve larger discounts relative to the marketplace. The first is we're typically buying these fund interests or company interests if we're doing a GP direct transaction without a lot of competition. So competition is the enemy, right? In a brokered transaction, a typical broker will invite 50 to 100 people to a competitive process. And that will produce maximum pricing to the point where arguably the winner is overpaying for those assets and accepting a below market return. With the absence of competition, we're either having bilateral conversations with a GP about a limited partner that wants to sell in their prior fund, or a GP is saying, I'm going to sell these assets, or I have this LP who's a seller. I'm going to invite you and 3 other of my LPs. So if you've got 4 people in a transaction, let's say, as a potential buyer, it's much less competitive pricing pressure. So you can achieve a 1, 3, 5, 7, 15% return relative, because you know that there aren't going to be 50 bids out there with somebody top ticking the market. The second way that we achieve discount in our transactions is frankly just knowing more about the portfolio. We're happy to pay if a seller comes to us. We're in August right now. If a seller comes to us and says, hey, I want to sell my fund interest in this particular fund, the capital account statement that they're providing us is from December 2020. They may have already issued the March financials, right? But typically the December financials are the fully audited financials. So the record date will be December, and we'll say, okay, we'll pay you par. But we know that the March financials show a 5 or 7% uplift. So we know that it's a 5 or 7 paying par off of December is actually a 5 or 7% discount off of March. But because we're so close to these managers and doing constant research on them and their underlying portfolios, we typically know what the June numbers are going to look like before they're even out. And so we might know that there's going to be another 5 or 7% write up in the portfolio because of underlying company performance or market multiples, and the seller doesn't know that. So paying par off of December, they may know is a 5 to 7% discount off of March and may be willing to take that because they don't have a lot of bids, right, driving up the price, which we know is another 5 to 7% gain because we know where the June portfolio marks are likely to come out. So that's typically that's the game we're playing. It's restricting competition and leaning in on assets that are very high growth so that the statement may not be out yet, but you know it's going to be marked up considerably.
Thank you, Mark. We have a couple of questions left and a couple of minutes to go. Thank you very much for all the audience. If you may have any question that we are not able to answer here, we are happy from the BICE team to follow up with those questions. And I think a final question regarding with also with competitors, something about leverage. So So one of the audience mentioned that usually secondaries GPs mention that they don't use leverage rather than for credit facilities for smooth capital calls. I mean, small, use of this leverage. But we are seeing in some cases that there are more leverage that from compared with that speech. So in your information, what you are seeing, what are the use of other competitors and what are the leverage to enhance these returns using those leverage as well as risk? Mark, you mentioned, Tom, you mentioned at the beginning that usually if you increase leverage, you create another, risk. So if you can elaborate on that, how does Stepstone deal with the leverage? What are the other competitors are doing with leverage and how that, affect the returns we're seeing? Thank you.
Yeah, so I would say, lots of managers say they don't use leverage, but some of them only use their capital call facility for the first 2.5 years of their life cycle. So they won't call capital at all for 2.5 years, and they will put everything on the line of credit. And, other secondary managers will use their capital call facility to enhance returns, but also put large portfolio purchases into a special purpose vehicle and get a asset-based loan against that portfolio. So they might actually only put up 50% of the equity to finance that portfolio purchase. That's typically done, particularly in these large multi-fund transactions that are brokered. You have to do that in order to win the transaction. You have to buy the overall transaction at a 9-10% IRR and a 1.2 to 1.3x multiple of money. And then they take 50% leverage, either in the form of their capital call facility or asset-based leverage by putting all those assets into an SPV and lever those transactions up to 50 or 60% to bridge from a 9-10% IRR and a 1.2x TVM to a 13-14% IRR and a 1.4x TVM. And so the problem with that is, there's nothing wrong with that. And to be honest, we've put lots of our clients, our advisory clients around the world. We don't tell our advisory clients to come into our funds because it's a conflict of interest. But we have put several of our advisory clients into these levered beta strategies, secondary strategies, and it is an effective way of making a return. But that's what it is. It's just levered beta, levered private equity beta. And so that's the way that the secondary market is using leverage. We don't use any asset-based leverage. We do use our capital call facility to finance transactions just so that we don't have to call capital every time we have a settlement. But every 3 to 6 months, we pay down our capital call facility and call the capital from our investors. So it's a much more natural, we can achieve the same return or greater if you compare our returns to the levered beta secondary managers. We can achieve effectively the same returns or better through an unlevered, alpha-oriented, first and second quartile focused purchasing strategy, while they achieve, similar returns by using leverage. And of course, the challenge with leverage is that in an up market, you look like a hero, but in a down market, it can be very dangerous. And the first losses obviously go to the equity investors in the fund. And so there's much more interim volatility in a leverage strategy than there is in a, alpha-oriented unleveraged strategy such as ours.
Thank you, Mark. I think we are just on time and really appreciate for being with us this morning, Mark and Tom, channels as well. For all the audience, thank you very much for sharing this morning. We will make all the follow-ups because we have couple of questions that but I think we can elaborate well those answers. And for all the audience, thank you very much for being with BICE. Hopefully, Tom, you want to say something?
I would just add, just before you
Sure.
sign off, I know that you
Sure.
didn't, but just as it relates to timing and schedule, I think as Mark has indicated earlier in the presentation, we're about close to 80% committed on our current fund and are beginning to raise our successor fund. So we anticipate holding an initial close in this calendar year for some of our existing investors who want to budget their allocation, a budgeted allocation for this year. And then we will have a close in January of next year. So while fundraising is certainly never easy, the returns for our current fund, we think on a comparative basis with other secondary funds, are quite attractive. And therefore, again, while we don't think fundraising is ever easy, we do think that interest in this fund, as we see in our returns and as we've seen from the interest lodged with us among our existing investor base and those other interested parties, we anticipate probably raising through the summer of next year.
Great. Thank you, Tom, for that information. So having said that, thank you, Stepstone team, and also well for all the audience, and see you soon, and hopefully in the new BICE webinar. Thank you, guys, and take care.
Thank you very much.
Thank you.
Guys.